So it turns out that there's pretty much nobody in financial history that is like Fred Carr. He was the leader of two major companies that failed. There's only one person who even comes close to being leader of two big successful companies that failed in the financial industry. Can you think of who that other one person is?
No, you texted me, and I deliberately didn't research this, so I don't know. By the way, the only person that I came somewhat close to this is John Merriweather, because didn't
Ah,
he? Is
that's
that
right.
the guy? Oh,
Yeah.
yes, nice. Because of
Yeah.
LTCM and what
Yeah.
was it, Salomon before
Yeah,
that?
Salomon Brothers. So
Yeah,
Salomon Brothers didn't fail necessarily like Fred Carr's companies failed, but they had this big issue where they were buying more treasuries than they were allowed to.
yeah,
And that really tainted the franchise of Salomon Brothers, and Warren Buffett came in and bailed out their reputation in the very
yeah,
early '90s, and then he was one of the leaders of long-term capital management. But, like, that really goes to show you that Fred Carr is kind of by himself in financial history as
yeah.
someone who
One of a
led
kind.
two of the major financial firms, to the top and all the way and rode them to the bottom.
Yep, indeed. Have you ever seen the show It's Always Sunny in Philadelphia?
Oh, a long time ago, yeah.
Okay, and you at the very least will remember the meme that everybody uses now to do any like conspiracy mongering, where it's Charlie Day in front of a big board with a bunch of strings around the name Pepe Sylvia. That's how I
Yep.
felt researching this episode. Everything connects. All of a sudden,
Yeah,
everything
it
started to
was a
connect.
much deeper well than I was expecting, that's for
This
sure.
is wild. Okay, you ready to go?
Let's do it.
Welcome to the fourth episode of Season 2 of Backtest, a podcast about defining moments in market history and their timeless lessons. I'm Daniel Gamboa,
And I'm Matt Harris.
and we are your hosts.
Before we dive in, a quick reminder that this show is for informational purposes only and it isn't investment advice. Daniel and I may have investments in the companies discussed.
Sometime in those early days, Fred had the now well-publicized luncheon with Mike Milken, where, over tuna salad at Cafe Beverly Hills, they decided to change the course of the financial services industry. Along the way, Milken would make himself a billionaire and be crowned the most influential man in American finance since J.P. Morgan in 1986, and then be thrown into jail for 10 years for securities fraud in 1991. What a lot of people don't realize is that none of it could have happened without Fred Carr. Anyone close to the situation would agree that it was Fred whose huge blanket purchases of Drexel's junk issues in the early 80s made Milken the junk bond king and paved the way for the stampede of business that would deluge Drexel, Burnham, Lambert. Matt, that's an excerpt from a book we both read called The Fall of First Executive by Gary Schulte, a book that you all listening to this will be glad to have let us read on your behalf, I'm sure, because it's a slog. But the story today is certainly not a slog. It's an incredible story.
The story is awesome. Don't read the book. Skip the book.
Yeah. Now, Matt, I think my guess is that most of our listeners will have heard of Michael Milken even before they listened to part one of this series about 80s on Wall Street. But I bet almost no one has heard of Fred Carr or his insurance company, First Executive. And that's about to change today.
Yeah, no, that's right. This is an incredible story, and this is a theory. I can't prove it, but I think there's a lot of evidence that Fred Carr was Michael Milken's mentor. Hear me out. Hear me out. So the first reason I think this is that in The Fall. So The Fall is the only book written about this period that I've seen that's written from an insider. Gary
Mhm.
Schulte actually worked inside First Executive, and he outright says it. He says that Michael Milken was a Fred Carr protege. Is a sentence in the book. Predator's Ball also says that one of the reasons that Michael Milken moved to LA was to be close to Fred Carr. And then to me, like, there's no way, in my opinion, that Michael Milken didn't know who Fred Carr was, because as we're going to learn, Fred Carr had a prior life where he was a very famous investor in the late 60s and early 70s. And that was right when Milken was at Berkeley and Wharton, studying finance. Fred Carr's running a huge business, famous business, right in his hometown of LA.
Yeah.
And so if I ever get to talk to Michael Milken, actually the first question I'm going to ask him is, was Fred Carr your mentor? Because I think he was.
Yeah, we know that they knew of each other. We know that Michael Milken, one of his parameters for moving to LA was this, even though it wasn't the biggest one. We don't know for sure that it was his mentor, but I like your speculation, Matt. I like it. Today's story is about the buyers of high yield bonds, and arguably the buyers are the ones that unlock the high yield bond market. And in a sense, they're as important as Michael Milken, who was making the market. And there was no bigger buyer in that universe than Fred Carr.
That's right. And before we jump into the story, a quick thank you to our presenting partner, EQT Corporation.
At Backtest, we study market cycles because patterns from history rhyme, whether it's unlocking capital with high yield bonds and private equity or unlocking the energy needed for AI applications. Understanding history gives you an edge.
A huge edge. And the company unlocking energy to power AI is EQT, producing American natural gas to help deliver affordable, reliable energy at scale.
So, Matt, we've now covered two major pieces of modern finance that come out of the 80s. The high yield bond market that we talked about in part one, that along with the leverage buyouts that we talked about in parts 2 and 3, restructured the corporate world in the US. We talked about Michael Milken scaling the high yield market at Drexel, and then Henry Kravis dominating LBOs. But there's a recurring element to all of this that we haven't really covered in depth yet, and that's the money, the capital behind all of this, right? You need three pillars. You need growth companies and leverage buyouts, demanding capital. So this is sort of the demand side of the equation. You need Mike Milken channeling that demand for capital into some sort of product, in this case, high yield bonds. And you need someone providing the capital to make the whole thing work. And that someone, more than anyone else here, is a guy named Fred Carr. And Fred Carr is one of the most fascinating and least known characters that we've covered so far in any series. He's also a little mysterious. I was reading this profile of him in the LA Times from 1990, and the reporter gets invited to Fred Carr's apartment for dinner. And Fred was known for being one of the most accessible CEOs of any major company in America. You basically could call his office and you could get him on the phone. Except he doesn't ever talk about himself. In the article, it says that Fred Carr's living room has dozens of little wooden Pinocchio figurines. A little weird. And when the reporter asks about them, Carr only says that it's good to collect things that aren't expensive, gives no context on why he has them or where they came from, and then they just move on. They start talking about something else.
That's a weird story. I keep reading over that and looking for something to make it make sense.
This is just weird. So he lives in a 2-bedroom apartment in this ordinary building on a busy street in Los Angeles. No flashy clothes. Like, he wears sneakers and jeans to the office. He avoids junk food. He doesn't eat anything that's bad for him. Doesn't go to big social events like you might expect from a big executive in LA. On the surface, he's very private. He's almost monk-like. But underneath all of that, by the 80s, he's actually also one of the shrewdest operators in the history of American finance. And to understand how he got there, I think we need to go back a little bit to the beginning. So he's born in 1931 in Los Angeles. His dad was a Romanian immigrant who started out selling vegetables from a pushcart on the Lower East Side of Manhattan. His dad eventually migrates out to LA, and the family ends up running a fruit and vegetable stand in Watts, which is a town in South LA, just north of Compton, actually. And they're working incredibly hard just to get by. So they are not a well-to-do family. His parents, Fred Carr's parents, they work 7 days a week at the vegetable stand. Fred has one sibling, an older brother named Jerry. And what's more, Fred was actually born with a club foot, which meant that his mom was having to take him by streetcar all the time to the doctor for treatment. So it's a pretty tough upbringing for Fred. And the parallel to Milken is really interesting because remember that Michael Milken's family is also pretty modest, also from LA, although a different part of town. Neither of these guys comes from the Ivy League or from the old money world that controlled Wall Street at this time. They're pretty much outsiders.
Yeah, actually, so I read that Fred Carr's name at birth was Fred Seymour Cohen. And at some point, he changed his name because he wanted to fit in better, which Michael Milken's dad did the same thing.
Yeah.
Right?
Common theme.
Yeah. And so all these guys that we're talking about, Milken, Kravis, Carr, we talked a little bit on an earlier episode about how in the 80s, Wall Street was experiencing just a massive change in who was working on Wall Street. And these guys are just right down the middle for examples of that.
That's right. Yeah. And there's another parallel too with Mike Milken, which is even as a kid, Fred is drawn to the markets. He says that he became really interested in stocks around the age of 10. And apparently he would spend his summers visiting the lobbies of brokerage firms. Back in the day, they would post the stock price on these big boards in the lobby of the brokerage firms. And so Fred would go there just to kind of keep track of what was happening in the stock market. And there's a Time article that says that every dollar that Fred made during high school, which was about $500 at the time, he ended up investing in the stock market and he ends up losing it all. But it doesn't matter to him, right? He loves the stock market. He's not deterred by the failure. He's hooked. And different from Michael Milken, maybe this is one of the key differences between them. Fred Carr's career trajectory is actually pretty messy. It's not linear at all. He ends up going to LA City College, but then he gets drafted into the Army in the 50s during the Korean War before graduating, so he doesn't actually graduate from college. After the Army, he bounces around. He doesn't have a degree. He ends up working at a gas station. He sells insurance door to door. He's kind of hustling, but he's really going nowhere. And I found some conflicting stories about how he ends up managing money. In a Time article, they have him joining a brokerage firm in 1956 when he was 25. But in a later profile, actually, in the LA Times around 1990, they talk about how he had all these side jobs until he was 32. And they say that he didn't actually get into investing until he was 32, and he joined a place called the Shareholders Management Company. Either way, Fred has something that a lot of credential guys don't. He's been watching the market since he was 10. And he's been investing since he was 14. He's lost money. He's scraped by. He's done all these blue collar work. And he has kind of this street level intuition about market momentum that you don't just pick up any other way. And he slowly builds up a reputation for being a really sharp stock picker. And he's doing his own analysis. He's going deep on companies. He's looking at the fundamentals. By the mid 60s, the markets are heating up, and Fred takes over what's called the Enterprise Fund in October 1966. The fund at the time has less than $20 million in assets. It's tiny. But Fred has been watching and studying and learning for over 2 decades about how the markets work, and he operates very different from everybody else. He has one secretary, and then he informally consults a group of third-party investment analysts that he calls the Dirty Dozen. Time magazine describes these as like loner, cynical types, but they're all very independent-minded people that are constantly looking at the market. Fred talks to all these people, and then he would just make a decision, an investment decision on some idea that he liked. And with all this in place at the Enterprise Fund in the late 60s, he's about to become one of the hottest fund managers in America in a way that says a lot about what he does with junk bonds later in the 80s.
And this is actually right as markets entered a very specific moment in financial history known as the go-go years, which are roughly 1963 to 1968. The go-go era marked the first major institutional wave of performance chasing institutional investors, right? So there had been performance chasing individual investors before. This is the first time that it's coming from institutions. Portfolio management shifted away from conservative, valuation sensitive investors towards aggressive growth strategies that were looking for short-term gains. Managers concentrated portfolios in small, fast-growing companies for the first time that were trading constantly. They were ignoring valuation metrics, and they were piling into illiquid stocks that would rise quickly as new money flowed in. They were specifically looking for companies that were about to be revalued as growth companies. That's what the Enterprise Fund spent a lot of time doing. In 1965, this approach from a professional investment firm was radical, but this emerged naturally. From 1950 to 1965, the markets were just a great place to be. They rose about 12% per year, with average inflation under 2%. There were some recessions in there, but they were pretty mild. So after 15 years of stability, investors began to believe strong returns were normal. And this type of behavior where you kind of get movement into momentum stocks is pretty normal after a period like that. The go-go years, actually, they produce some of the first modern celebrity money managers. Investors like Jerry Tsai of the Manhattan Fund is pretty famous in history, John Templeton of Templeton Growth, and Fred Carr of the Enterprise Fund. The world is watching these guys and their lives pretty much as closely as they're watching the stock market themselves at this point. And people tend to forget that actually Fred Carr had the best track record of all these companies.
People tend to forget Fred Carr, period.
Yeah, Fred. Just side note, I looked up like who were the go-go stocks that we might know today, and like who did Fred Carr like. And there's a lot of funny stories of Fred Carr being in rooms with like dodgy Wall Street managers, and they're talking about how they love IBM, and Fred Carr loves KFC. he's just stumping for the Colonel all over Wall Street, and he loved franchises, and so that was kind of his thing. And his returns were great. Enterprise Fund returned 117% in 1967 and 44% in 1968. It was the number one mutual fund in America 2 years in a row. Assets exploded from that $25 million number where they started to over $800 million in just 2 or 3 years. But that growth wasn't just from investment gains. It was actually mostly from cash inflows. for the first time, mutual fund investors could see that, month to month performance in the rankings, and they could move money constantly into the top performers. And so Fred Carr is the top performer for several years in a row. And these fund managers can't really hold cash, right? Because that cash would be a drag on their relative performance, and the growth would stop. In the go-go era, quarterly rankings were everything for institutions, and this is the first time we're really seeing that out of the institutional world. So that money gets invested immediately, often into small cap momentum stocks that just were hard, that would be hard to sell, but nobody cared because these stocks were going up, 50, 60, 100% a year. And just to give you a sense for how frothy things are getting toward the end of the 60s, Warren Buffett, after having a great track record in the 60s, 1969 is when he famously shuts down his investment partnership and sent investors their money back, saying there's nothing good in the market to invest. And if you want to get a little nerdier here, if you follow NYU professor Aswath Damodaran, he publishes this data set about equity risk premiums, which goes back to 1960. And this time period, the late 60s, is the only time other than the tech and telecom bubble where the equity risk premium or the return you're getting on equities over treasuries goes below 3%. And so you're in a sort of a similar valuation period to the tech and telecom bubble. But these stocks aren't just getting expensive. We're structurally fragile here. By the late 1960s, inflation's rising unexpectedly. Interest rates are moving higher. That's our friend Bill Martin raising interest rates at the end of the 60s to try to cool off the economy. And anything with high valuations just coming crashing down. But because these mutual funds offer daily liquidity, investors could redeem shares at any time. And so when that performance faded, redemptions followed, because the only reason people were investing in these companies is because of their short-term outperformance. So as soon as that goes away, they're all sellers. But the late 60s, early 70s recession and bear market was actually pretty normal, nothing crazy. It's not the kind of thing that puts investment companies out of business, except enterprise fund. Yeah. So Fred Carr had built a lot of his reputation around buying these things called letter stocks. These are restricted shares that you buy directly from the company, and you can buy them at like a 20 to 30% discount to the market for the specific reason that they're not saleable for a couple years after you buy them.
They weren't registered, right? They're not SEC registered, so you can't trade them in a public exchange.
Right. And so in rising markets like 66, 67, this is awesome, right? Because you're getting not only the momentum from the market, but you're getting an additional 20 to 30% because of the discount you bought it at. But when investors rush for the exits, enterprise fund has a fatal flaw in that they have a structure that has daily liquidity in the mutual fund, and they have a ton of assets that they can't sell. So
foreshadowing.
Right. And so assets collapse, performance collapses. In 1969, Fred Carr resigns in disgrace. This is kind of a hero to zero situation. He's now labeled in the press as Fred Carr the gunslinger, which is like the opposite of what you want to be known at as an investment manager. And he's very down on his luck as we close out the 60s.
Yeah, he really is. So he walks away from the enterprise fund in 69. He's in his late 30s by this point. So he hasn't had a long career. Remember, if that second story is true, and he actually started at 32 years old, he hasn't had a massive career just yet. His reputation is pretty tarnished, but there's enough people out there who think he's a genius, and he's still managing money. Apparently, he was also teaching a graduate finance class at UCLA. It seems like he pulls back, kind of regroups, maybe goes back to fundamentals. We don't know exactly what happens over the course of these kind of couple of 5-6 years. But then in 1974, there's another opportunity that pops up for Mr. Fred. There's a tiny life insurance holding company in Los Angeles called First Executive Corporation. And it's essentially insolvent. It's about to default on its bank line of credit. It's bleeding cash. And Fred gets recruited to the board by a guy in Beverly Hills named Al Handschumacher, who is president of the Lear-Siegler Corporation, the Jets company. And in July 1974, a couple of months later, Fred gets elected president of First Executive. And he effectively starts working on his second chance. This is his redemption tour. So when Fred takes over at First Executive in 1974, the situation is just about as bad as it can be without the lights actually going off and the company just shutting the doors. The firm has $77 million in total assets. Among U.S. life insurance companies, that ranks at 355th, which is almost dead last. It is defaulted on a $15 million loan from Citicorp. And, as if that weren't enough, its accounting firm, Touche Ross, refuses to issue an opinion on its financials. which if you're not familiar with what that means, when an auditor refuses to sign off on your books, it's kind of like your doctor not giving you a clear bill of health after a physical and not telling you why. It's a huge red flag. And so Fred spends the first year or two triaging over all of this and trying to fix it and bring the company back to some level of stability. He gets in with banks, he restructures the debt, and he starts paying it down. The previous management team had made 2 foreign acquisition attempts, and Fred unwinds those. He's basically clearing all the rubble. And while he's doing all of this, he's going to school on the insurance industry. He had never been in it before. He's trying to figure out what matters, who the players are, what are the rules of this game, how do you win? And what he finds is an industry that feels almost the opposite of where he came from. The mutual fund world was governed by all these federal laws and it was intensely competitive. But insurance is kind of a patchwork of state commissions. There's 50 different regulators. It's very bureaucratic and slow, and it's insulated. The big players like Prudential and MetLife, they're pretty comfortable, and it's all pretty sleepy, but it's also very inefficient. It's worth pausing here for a second to talk about how life insurance companies work. The product is life insurance, obviously. So customers pay a premium. The company pays a lump sum when they die. The company's job is to understand mortality statistics, so how likely their customers are to die in a given year, because that determines how much they need to charge in premiums, right, to make sure they stay solvent. I always picture kind of a cash flow timeline. So there's all these small inflows coming in, and then there's a big outflow in the future that you have to prepare for. But before that big outflow, there's a pool of cash that the company can invest. And the dominant product before and during the 80s was something called whole life, which actually has a savings component to it in the product for the customers. So you get not just a death benefit at the end, but you also get a savings component that grows tax deferred over time called cash value. The key for the insurance company is that they need to earn a higher interest rate on the cash than what they're paying out in that savings component. And so if you're promising customers 4% on their cash value, you need to be earning more than 4% on your investments. And that gap or spread is the company's profit. The key with these savings products is that the customer can pay a penalty to withdraw their savings early. So say 5% of the savings. They can also borrow against it. So that's a selling point. You basically can take a loan out on the value of your cash that you have saved with the insurance company at a predetermined rate. And that's the basic product of a life insurance company. There's one more piece to understand how these companies are valued, which is insurance companies are required to hold what's called reserves. And that's the money that they set aside to pay future claims. Whatever they have above those reserves, it's called their capital surplus. And this surplus is kind of their cushion. It's their margin of safety if markets were to go down. And this is what regulators and rating agencies and investors all really focus on, because it tells you what the health of the company is. So the bigger the company's surplus, the stronger you look as a company. So the 2 key points to remember from this little aside is that the spread between the interest you're paying on those savings to your customers and when your investments are generating is your profit. And the second point is the way to measure the company's health is that concept of capital surplus. So in the mid to late 70s, the insurance giants are investing in low yield government bonds and mortgages, and they're paying policyholders about 3 or 4% on their standard whole life policies. That's a terrible product. When inflation is hitting double digits, your policy is actually losing value every year.
Yeah, so the period we're talking about now is the end of what's called the Great Inflation. The Great Inflation lasted from 1965 to 1982, and its most intense sort of existential period was 1979 to 1982. This is when inflation in America got almost to 15%. Federal Reserve Chairman Paul Volcker raised Fed funds rate, the lowest rate in the whole market structure, to nearly 20%. And that was meant to bring inflation down, but this fundamentally broke the existing business models of America's banks and insurance companies, and they had to adjust. So take savings and loan banks, for example. They had a very simple model. They take in deposits, and they use that money to fund long-term home mortgages. That was the whole purpose of an S&L bank. But regulations capped what they could pay depositors. It was often around 5% based on this thing called Regulation Q. And their charters required them to invest primarily in 30-year fixed-rate mortgages. So that works fine in a stable, low-rate world, but this model failed instantly. Once market interest rates surged into the teens, depositors fled. Instead of just 5%, now they can get 15% from the money market. which sets off it's a run on the bank. And this actually resulted in the third biggest financial crisis since the modern Fed has been in place. That the failure of this S&L model. Insurance companies faced a different, but really equally dangerous problem with their business model. Every financial intermediary could not survive the end of the Great Inflation with their existing model, and so the financial system up to this point had really been designed for stability, and it was not made for this kind of volatility that we saw between 79 and 82 when interest rates exploded. These old models just they are not working anymore. And a lot of the story of Wall Street in the 80s is really the story of banks and insurance companies and capital markets scrambling to learn how to operate in the new structures and new models they had to create to survive the world created by the Great Inflation.
Yeah, so bringing it back to the insurance world, Matt, basically what's happening is people are waking up to this and they're surrendering their policies. They're moving their savings into money market funds, like what you talked about, where they can actually get a yield that's higher than inflation. Actually, the smart ones are just borrowing against their savings because the rate to borrow was set in their contracts and it might have been something like 5%. And if you just borrow that cash from your insurance company and you pay them 5% interest and then put it into a money market fund that might be earning like 8, 9, 10%, you're much better off and you don't have to pay a surrender fee. So that's what the smart people are doing. Fred sees this from First Executive's standpoint, and he doesn't see it as a threat, right? Because they're basically a blank slate. They're a tiny company. They don't have a massive book to work with. He kind of sees it as an opening, and he's working to figure out how to take advantage of this. So he and a team of people start developing a series of annuity products, really just a contract where you hand a lump sum to the insurance company and then they invest it on your behalf and they grow it. And these compound tax-free. So you don't pay taxes on the gains until you actually withdraw the money, which is really attractive in a world of high inflation and high tax rates. We're going to talk a lot more about these products in a bit. The problem is that the yields Fred and other life insurance companies can offer aren't really that compelling. If you're going to convince someone to surrender their existing policy, pull money out of a money market fund, and then put it into your products, you need to show them something that's meaningfully better. Otherwise, they won't do it. So in 1977, Fred Carr goes to Cafe Beverly Hills and has lunch with Michael Milken. And if you remember from part one, at this point, Mike Milken has proved his theory on non-investment grade bonds. He's doubled the money that Drexel gave him to manage, and he's starting to explore opportunities to scale this market, right? He's in the early innings of identifying pools of capital to try to expand this market into original issues, not just fallen angel bonds to invest in. Michael has this great product. He's got yield. He just needs a few large, patient institutional buyers to help him scale this. And Fred listens to all of this. And I think he probably has what I think is maybe one of the most impactful finance insights of the 80s, because at this point he realizes that his problem is the mirror image of the problem that Michael Milken is trying to solve at Drexel. Michael has an almost unlimited supply of high growth, capital hungry companies willing to pay a premium yield to anybody who will lend to them. Fred, on the other side of this, is sitting on an insurance platform that desperately needs high yielding assets to back these products and make them competitive enough to win customers in a high inflation world. So Michael needs capital and can offer yield. Fred wants a high yield and he can get lots of capital if he has it. And so it's a perfect match. And what Fred does next with that insight, the products he builds, the machine he creates to sell it, and just how much capital starts pouring into this whole thing is basically the fuel for the high yield bonds and leverage buyout revolution that we've been talking about this whole series.
So it's really two revolutionary products that we're talking about here. One is Michael Milken creating the products that insurance companies need. They need these to transition their business models to the post-Great Inflation world. And the other is Fred Carr, who's creating new insurance products using the high yield market really as Milken is creating it. And just to take a step back, both Milken and Carr's products rested on Braddock Hickman's 1958 research, where he analyzed high yield bonds from 1900 to 1940 to make the very strong case that high yield bonds actually are a good investment as long as you're diversified.
And if you're listening and you're wondering who Braddock Hickman is, he is basically the prophet of the high yield bond market. And so if you want to learn more about that, go back to part one. But he underpins the theory that Milken is using to build this market up, scale it up.
Right. But even in the 70s and 80s, this is still very contrarian thinking, even though Braddock Hickman, who was the head of the Cleveland Fed, right? He was like a legit guy, published this research, and it was just analysis, right? It wasn't like
Yeah, just math.
some crazy theory. It was just analysis of what had actually happened. Everybody at this time still hates high yield bonds. And one of the most important points to understand in this whole story is that Fred Carr and First Executive were really inventing insurance products and reinventing the insurance market at the same time that Michael Milken is reinventing corporate finance. And in my opinion, these are equally big deals.
Yeah, and interrelated. I think they kind of unlock each other.
Yeah, they can't have one without the other. Michael Milken is much more famous. Meanwhile, Fred Carr, you can't even find this guy's picture online. But like what he did in insurance and how that underpinned and interacted with the high yield market is a very big part of the history of Wall Street in the 80s. And so this is going to be huge, right? Let's talk about these products that Fred Carr invented in the 80s. First Executive was actually pioneering a new product called single premium interest sensitive products, right? So you're exiting the great inflation and now things have to be interest sensitive. Otherwise, your business model doesn't work. The concept behind single premium interest sensitive products is very simple. Instead of paying premiums gradually over decades, customers made one large payment upfront. That money compounded tax deferred inside the policy, and the insurer promised a future payout at retirement, over a defined time period, maybe after somebody died. For the insurance company, this meant something incredibly powerful, which meant that the investable capital arrived immediately at the beginning of the contract, and it didn't need to be paid out sometimes for decades, right? Sometimes for 50 years if you're insuring somebody young for their life insurance. These products attracted all kinds of buyers. Individual savers used them for retirement and for life insurance vehicles. Pension plans used them when they were restructuring benefits. We talked a little bit in episode 2 about how this law called ERISA really clarified what the responsibility of a pension manager was. It also caused a lot of corporations to kind of throw their hands in the air and say, okay, this is being regulated now, and I'm not an investment manager, and there's all these new rules, and so I'm getting out of this business of pension management because I'm a car company or I make hats or whatever it was. And so you actually had a ton of companies cancel their pension plans when markets surged between 1982 and 1987, and their plans became pretty materially overfunded from the market surge. They realized they could terminate those plans, transfer the vested obligations to insurers like First Executive, and put them in these single premium products, and end up with a bunch of cash that they could spend on their business or pay out as a dividend. And so hundreds of pension plans were shut down in the 80s. This was tens of billions of dollars of capital flow. This is roughly 0.5% of GDP. This cancellation of pension plans actually sends a huge pool of money to life insurers and makes them flush with cash. And life insurance companies become the biggest buyers of high yield bonds in the 80s.
Matt, it almost strikes me, we talked about in the last couple of episodes that during this time period, a lot of companies are going from being a conglomerate to being more focused on a specific vertical or a specific business. It seems like this is right in line with that trend where you're outsourcing things that are not part of your core business, right? And a pension fund is definitely not part of the core business of most companies.
Yeah, good point, right? Another big capital flow for these new products was actually municipalities became another major source of funds for single pay products. So cities and states are raising a bunch of cash in the municipal bond market, and they're actually placing those proceeds into these single payment insurance products while they wait to spend them on things like highways and bridges and schools and other infrastructure. These were called muni GICs, which is fun to say. It stands for Municipal Guaranteed Investment Contract, and this was a big part of the market too. And these were some huge new products because nearly all of First Executive's liabilities came through these single premium products. The company was unusually operationally efficient. These are very simple contracts, right? There's one payment in and one payment out, 10, 20, 30 years later. So administratively, these are very low cost. And so on a per, revenue per employee basis, First Executive was number one in the industry. Now, it's one of the reasons that legendary investors like Peter Lynch owned really a lot of their stock.
For the uninitiated out there, Peter Lynch was the manager of the Magellan Fund at Fidelity. And at this time in the 80s, everybody listened when Peter Lynch spoke about investing.
Right. And so growth for these products absolutely explodes in the 80s. First Executive's assets surged from 1.4 billion to more than 16 billion by the end of 1987. This is one of the fastest, if not the fastest, organic growth run in the history of the insurance business. And the growth driver for that was really three powerful things coming together at once, on top of innovative products that were solving real problems for people and pools of capital. The first major force is that Fred Carr didn't just reinvent insurance products; he also reinvented the incentive models for agents selling life insurance. For example, he created a way for the best agents to participate not just with an upfront commission and then that's it. He made it so that they could participate in the ongoing cash flows for the whole life of the policy. The other major force was that because Executive Life owned way more high yield bonds than any other insurance company, the insurance products themselves offered much higher returns than competing insurance products, actually about 20% higher than other products for the entire decade of the 80s. And the third major force that drove the explosion of demand for these products, this is really the big one, is that First Executive had ratings from key rating agencies that put them in the top 2% of all life insurers in terms of safety of their policy payouts. So investors are seeing 20% higher yields than everything else and super safe, extremely safe, no risk is what they're seeing when they look at the ratings. And a lot of the markets that they were in, like pensions and muni GICs, required these ratings. And this is the big one. It was these ratings that really accelerated things. After they entered this top 2% class in 1986, their assets exploded from 8.7 billion in 85 to 16.4 billion in 87. So you had a very powerful flywheel here. You had innovative products that attracted capital. You had high returns driving demand. You had strong ratings unlocking huge institutional markets, and expanding assets allowed even larger investments.
I think Fred Carr actually is the glue that holds all this stuff together. I'm trying to think through in my head, trying to put puzzle pieces together, because one of the fundamental questions as I listen to this is, why did nobody else do this? Why did nobody else try to replicate this? And I think actually First Capital tried, and I'm sure other people tried, but nobody was Fred Carr. One of the things that is undersold in all the stuff that we read, just reading between the lines, is the fact that these kinds of things, like Peter Lynch and John Templeton and all these guys being enamored with Fred Carr, tells me that he was probably a Steve Jobs charismatic. He's not going to go into a room and be the life of the party charismatic like Aubrey McClendon. He's going to walk into a room and demand the respect of everybody who thinks he's a genius. He's doing something nobody else can. He's putting all these things together. Nobody else can do this.
Yeah. And so at one point, Peter Lynch actually says he would rather have Fred Carr running his company than the executives at General Motors. And so this guy is on a pedestal, right? At this point in the story has gone from 355th, very bottom of the barrel, and now they're a top 10 life insurance company in America. And so in the mid 1980s, almost 2 decades after the enterprise fund debacle, it feels like 1967 all over again. And once again, Fred Carr looks like a genius. Everybody loves him. He's critical to the scaffolding of the high yield market in the 1980s on Wall Street. And with that, this is a great time to thank our presenting partner, EQT.
In essence, one of the key lessons we learn over and over again in these series is that operating with rigor and thinking deeply about risk management is critical to capitalizing on booms and navigating corrections.
That's right. And operating with rigor to deliver the natural gas to fuel the AI boom is a key focus for EQT. EQT is focused on the infrastructure that makes growth possible, building and modernizing the energy systems that deliver affordable, reliable power where demand is rising.
Which matters because the AI boom isn't just about models and compute. It's about whether data centers and digital infrastructure can actually get the baseload power they need with uptime and efficiency.
EQT focuses on the enabling layer, supporting the energy infrastructure that helps transform technological breakthroughs into scalable real-world solutions.
To learn more, go to poweredbyeqt.com and be sure to follow them on X and LinkedIn. Big thanks to EQT for helping us bring you the stories of market history and how they apply today. So Matt, back to the story here. Let's zoom out a little bit and look at where First Executive is by the mid-80s, because what Fred built has now become big really fast. And what comes out of all of this is actually pretty extraordinary. So the LBO boom, the leverage buyout boom, is in full swing at this point. The Drexel high yield machine is churning out deal after deal, and leverage buyouts have gone from about 10% of new high yield issuances to about 30% by the mid 80s. There's more deals, there are bigger deals, more bonds to place, and First Executive is there for pretty much every single one. By 1987, Fred has participated in 90% of all Drexel underwritings, which is about $40 billion in bonds between 1982 and 1987 alone. That means that First Executive owns the world's largest high yield portfolio at this point. What makes all of this even more remarkable, and honestly, maybe a bit questionable from a portfolio management perspective, but we'll get there, is the fact that the relationship between First Executive, Drexel, and these LBO deals is somewhat circular. One example of this, one very prominent example, is Ron Perelman, who takes over Revlon, a very famous LBO in the 80s. And Ron Perelman used Drexel Finance high yield bonds to acquire Revlon. And then First Executive had purchased a big chunk of those bonds. Once the deal closed, Ron switched Revlon's pension plan to First Executive. The same coverage that had required about $124 million for Revlon previously now cost $85 million, which then means Ron Perelman can cash out $39 million from the pension fund and deliver himself an immediate return on investment. And so there's nothing illegal about this, but you can see how it might be an issue that Fred Carr's decision to invest in the high yield bonds is not just influenced by the underlying quality of the bonds and the company, but it's also influenced by the fact that there's almost like this quid pro quo element into the deal where both companies kind of look better in the short term because they're working together, but it's all kind of intertwined, right? Like there's this risk dependency between the two of them.
Yeah, right. Like this happened in a couple deals. And as we get further into the 80s, there's more media backlash, more political kind of hating on the high yield market. And this is one of the areas where you're kind of like, yeah, maybe this is a little circular.
Maybe not such a good idea. Well, by 1987, 50 to 60% of First Executive's entire investment portfolio is in junk bonds. This is something that no insurance company would do today. Actually, they can't anymore. But this is a little bit questionable. Arguably, though, at this point in 87, it's a contrarian investment strategy that is paying off because First Executive is growing like crazy and they're delivering on the spread and they're very profitable and all these investors are backing them and everybody thinks the world of Fred Carr. Fred isn't hiding any of this. He's defending it publicly. He's defending it aggressively. He's calling out all the other insurance as being too conservative. He's arguing that their low yield bond portfolios are actually the dangerous ones, that if anyone forced them to mark their holdings to current market values, it would wipe out their net worth. There's an 84 interview with the LA Times where he says, quote, "If your portfolio doesn't generate capital gains consistently, if investors are not interested in buying what you have, then you're not buying the right things," unquote. So he's pretty direct in talking his book, but also he's a believer in this Hickman theory and in the gospel according to Michael Milken, so to speak. But you got to remember, right? We talked about Hickman at the top, and it's all over part one. Hickman's study didn't just conclude that non-investment grade bonds tend to be underpriced, right? There's another element of his study that is super important to this whole Fred Carr episode.
That's right. And for that, we got to go to the research and we got to bring back Professor Hickman from Austria.
Let's do it.
The investor's experience with the low-grade bonds varies markedly with the period of purchase. When acquiring after seasons of distress, the generous yields may more than compensate for default losses. But when purchased amid widespread enthusiasm and rapid new financing, the subsequent record is distinctly less favorable.
Yeah. Well,
the bonds!
Well done. So yes, exactly. So by 86 and 87, the optimism in the market is running really high. There's actually evidence that Fred knew this, that he was aware of this. There's another LA Times article that in 88, he acknowledges that high yield bonds were getting a little overpriced, but he really had no appetite for selling them. He's in growth mode, and all he wants is to keep growing assets. And so, Matt, what makes this story so fascinating is that there was a system in place that was supposed to catch this kind of risk, right? There are regulators, there's insurance commissioners, there's capital rules and requirements, but that system wasn't really designed for the world that we're transitioning into. It was designed for a very different world of government bonds and much more conservative products and a much more forgiving interest rate environment. Nobody had written the rules for what Fred ends up building here. And for a interest rate inflation dislocation that affects every major financial player. And that gap between what Fred has built and what the regulators are looking for is pretty key to this story.
At this point, Executive is effectively a high yield bond fund wrapped inside of an insurance company structure. It had grown to the 10th largest life insurer in the United States. Like you mentioned, 60%. 60% of their investment portfolio was in junk bonds. In 1988, the junk bond market's about 160 billion, and so that means if you do the back of the envelope math, First Executive 7 to 8% of the high yield market, just to kind of give you a sense of how big they were. And while the high yield market and equity markets actually are still booming in the late 80s, 88 and 89 are good years. The warning signs are starting to accumulate. Starting in the spring of 1988, Alan Greenspan's the head of the Fed now. He came in the summer of 87. He's starting a hiking cycle. We had Black Monday in October of 1987, the worst day in stock market history, where the market fell 22.6% in a day. But the economy was fine. And actually, by the spring of 88, everybody's kind of looking around and wondering what the heck just happened. But things seem fine. Inflation's starting to pick up. And so Alan Greenspan's starting to raise interest rates again. Economic momentum, again, it's not falling, but slowing. By the second half of 1989, GDP growth had fallen from the mid fours and kind of the mid 80s to the below 2.5%. And importantly, by the summer of 89, the yield curve is inverted, which is a classic sign that a recession is coming normally. And the markets are increasingly uneasy about this. And the elephant in the room in the high yield market is that Drexel Burnham and Michael Milken, the firm that has been just absolutely dominant in the junk bond market, they've been underwriting at least half, and if probably closer to 2/3 of all new issues and all secondary market liquidity. At this point, they're under federal investigation. Drexel faced indictment. They actually were threatened with a RICO charge, which is supposed to be for the mob. And so people are kind of like, what am I missing here? That Drexel Burnham is
Giuliani.
Yeah. And so everybody's super worried that the foundation, truly the foundation of the high yield market is about to just fall out from underneath it.
Well, we should qualify this. Investors are worried that the foundation of the high yield market might fall out. The general public is cheering, right? And so is Congress to some extent as a derivative of the general public, because they hate the junk bond market. They hate leveraged buyouts. They hate corporate raiders. They absolutely hate everything that's been happening on Wall Street this whole decade.
Right. Yeah. And there's actually, at this point, there's a lot of proposals in Congress about limiting junk bonds, trying to limit the interest deductibility of high yield bonds, trying to make it so hostile takeovers are not possible or even illegal. None of these cracks are visible to anybody looking at Fred Carr and First Executive in the late 80s. Insurance accounting rules actually didn't require bonds to be marked to market unless losses were deemed permanent. So a bond could be trading at 50, 60, 70 cents on the dollar in the market, but it could still be carried at full value on balance sheet as long as it hadn't defaulted and the accounting firm didn't think it was going to default.
Part of the reasoning, right, is that if you intend to hold that bond to maturity, then who cares what the bond is trading at? As long as it's paying you the interest rate that it's supposed to be paying you every month or every quarter or every year, and as long as they pay back the principal whenever the bond matures, then who cares what it's trading at, right?
Right. Those top 2% ratings that really put First Executive in a very special category in terms of their perceived safety are still very much in place and untouched. And so the risks are building here, but they're pretty much invisible to the outside world looking at First Executive.
Yeah. Well, and what you just described, the standards loosening as the boom matured, and then the risk building in the portfolios that looked fine on paper that people generally weren't particularly worried about on Wall Street is one part of what makes what happens next so striking, because at the same time, something else is happening, right? The public narrative is turning. We talked about people being upset about this stuff and Congress, positioning to potentially do something about all this populist backlash against what's been happening with leveraged buyouts. By the late 80s, high yield bonds, and from now on in the episode, I'm going to start calling them junk bonds to really capture the essence of what was happening with public sentiment. They become the villain. So those risks that were somewhat invisible are about to become very visible, because going back a couple of years in 86, Ivan Boesky had been indicted, like we talked about in part 1, for insider trading. And we talk there about how he cut a deal with prosecutors and he cooperates, points the finger to Michael Milken and to Drexel. And so that is how Drexel comes to be in this indictment and facing RICO charges from Giuliani. And so what matters to Fred's story isn't so much the legal drama of everything that's happening with Drexel and Michael Milken. It's the fact that, like we talked about, Michael Milken was the junk bond market. He was the market. And so he was the buyer of last resort. He was the price setter in the market. He was the market maker. He was basically the person on the other side of every trade. And he had, as one analyst at the time put it, uniquely controlled the financing and the distribution, the secondary trading, all of the things that made the junk market function. You take him out and you take Drexel out, and there's no market. The market breaks. And that's exactly what happens. Drexel starts hemorrhaging cash and clients. They're in settlement talks with the government. They're burning through capital. And this all feels like a house of cards waiting to fall at this point.
Right, and it does fall. Starting in the back half of 1989, demand for high yield bonds begins to collapse. In August 1989, Congress passes an act called FIRREA, the Financial Institutions Reform, Recovery, and Enforcement Act. It was designed to contain the savings and loan crisis, but it had enormous unintended consequences for the junk bond market. Savings and loan banks had become the second biggest buyers of high yield debt during the 80s after insurance companies. And FIRREA didn't just say, hey, you can't buy any more high yield bonds. It actually said you have to sell all your high yield bonds. And so this creates a huge sort of downward pressure on the high yield market. At the same time that FIRREA gets passed, insurance regulators begin tightening their standards. They introduced a more granular bond classification system that increased capital requirements for lower rated securities, which makes it way more expensive for insurance companies to own junk bonds. Meanwhile, in the pension fund world, remember pensions are the third biggest buyers of high yield bonds. There's some things going on around ERISA and all the stuff in the media makes fiduciaries at pension funds grow concerned about the legal exposure tied to speculative investments. And so by early 1990, the brakes are kind of being slammed on the high yield market across all three major sources of demand: insurance companies, savings, loan, and pension funds, which together account for probably 2/3 of the market's investor base. Back of the envelope math, 35 to 40% of the demand for high yield bonds just got erased from the market through this. And we talked to somebody who was in the market at this time, and he said, even though all this stuff was going on and you had all this demand destruction through regulation, the biggest thing was Drexel.
Part of what's so important about Drexel, too, is that Drexel was effectively half the market. And if you look at Drexel's market share, hovered between 40 to 60% across the entire 80s. And the second biggest market maker in high yield bonds was single digits. So if they disappear, half the market disappears, but that doesn't really capture the gravity of it, because if half the market disappears, everybody else is going to be gun shy. So that means that 75% of people making a market in high yield bonds are gone.
Yeah, and when we say gone, in February 1990, Drexel filed for bankruptcy. They filed for Chapter 11. So overnight, the junk bond market loses its dominant underwriter, trader, and market maker. And so the impact of this is immediate, and the market collapses and defaults start to surge. Like we said, for most of the 1980s, junk bond defaults averaged, around 2% or so, really low enough to validate Braddock Hickman's research. In 1989, they get up a little over 4%. Just for listeners' context, average across cycles is about 4%. In 1990, they exceed 10%, and then they do it again in 1991. And so you had 10. So across 89, really mostly the back half of 89, 90, and 91, you had 25% of the high yield market default.
If you've never been exposed to what it's like to manage an insurance portfolio or any of these types of portfolios that are full of liabilities and dependencies, going from an assumption in a model, in a portfolio construction model of 2 to 3%, 4% in a distressed environment, and taking that to double digits will break any portfolio design, unless you're very conservative and thoughtful and expected that things will break, which is why we study history, right? Because even in new asset classes, you have proxies where you can think through how this might work, even if you haven't ever seen it before.
Yeah, and so this all really comes back to Hickman, and this is a point that often gets missed, but it's worth mentioning here. So his 58 study was examining fallen angels. So they were bonds issued by investment grade companies that were later downgraded. And the inefficiency he identified came from forced institutional selling. You had a lot of investors who just couldn't own high yield bonds and had to sell them once they got downgraded. And that dumping of the bonds creating a price inefficiency. But by the late 1980s, the junk bond market was, 10 times larger than anything Hickman ever probably imagined and definitely studied. And way more of these bonds were very speculative. These were companies that existed only because Milken's financing machine made the issuance possible. And so this is really a fundamentally different market than what Hickman studied between 1900 and 1940. And the open question was whether Hickman's conclusions still applied at this scale. Ultimately, the answer would be yes, but with much bigger drawdown periods than what anyone would have modeled up to this point. And then you layer over all of this the dramatic political shift. Regulators who had been largely passive during the boom suddenly became very aggressive. Feria marked the beginning of a broader crackdown, and the institutional infrastructure supporting junk bonds, the buyers, the market makers, and the underwriters, was really dismantled from multiple directions at one time. And the price of bonds inside First Executive's portfolio are falling fast.
Well, the first public shoe drops on January 19th, 1990, where First Executive announces a write-down of $550 million on its junk bond portfolio. And by the way, this happens only 3 months after First Executive had closed a really complicated equity raise of $300 million that wasn't particularly well received, actually, by the market. And the write-down is pretty key because up until this point, the press had been circling around First Executive. The stock had started to fall. There's a decent amount of short selling pressure. Remember, Fred Carr has been out there talking about junk bonds being fantastic and how he's so contrarian. And now that skepticism is bubbling up into much more aggressive pressure against First Executive as the market is turning. And this write down ends up confirming that the portfolio of junk bonds inside of First Executive is in fact partially impaired. And even though they're only realizing a 1% to 2% loss year in their investments, it signals that there may be more to come, that things might actually be worse. And now the publicity really goes off a cliff. But more importantly, the rating agencies take another look and they downgrade First Executive. And you've made the point several times that this was a critical piece, that these really high ratings that placed them at the top 2% of all companies were massive for attracting capital. And so now that they're going to get downgraded, plus the combination of all the publicity, really makes policyholders worry about their savings and starts triggering surrenders. So people are paying a 5% or so penalty to pull out the value in their policies before it's too late, before they actually lose any more money. Fred goes on defense to try to stop the bleeding. These surrenders aren't that bad. There are some people triggering it, but it's not everybody. So Fred goes on defense and he gets out there and he goes on a roadshow. He's basically trying to reassure investors and analysts and policyholders. He's making the case that the portfolio is sound. This is temporary. Nothing to see here. It's going to be okay. And it fails completely. In fact, Peter Lynch, the legendary Fidelity manager we talked about, he's sitting on roughly 11% of First Executive stock at this point, and he listens to Fred to his pitch defending what's happening, and he says, quote, "Fred, I've been listening to you for an hour, and you sound to me like someone who's shorting the stock," unquote, which has to have been a huge blow. Like, that is a horrible thing to hear from one of your top, if not your top investor. Peter Lynch, sure enough, ends up liquidating his position the next day. And by this point, the company has entered a death spiral.
And so as we get into death spiral mode, it's worth revisiting how to think about the health of an insurance company. You take everything the company has, its investments, its reserves, all that, and you subtract everything it owes to policyholders. And what's left over is the company's equity. If that number goes negative in an insurance company, you're in serious trouble because you owe more than you have, right? And this is life insurance. This is not monopoly. This is people's life insurance. You can't go negative. And so at this point in the story, actually, even after this first write down, First Executive is fine on a statutory basis, but things are just getting started here. And I got to make the point, Fred Carr hadn't failed at making sure his assets and liabilities were well matched. It's easy to think that he failed there.
It is. I think that. Go ahead, make your case.
Essentially meaning that the high yield bonds he owned were set to mature before the insurance policies needed to be paid out. Actually, he didn't invent asset liability matching that had been around for a while, but according to the biography, he built an entire balance sheet around asset liability matching. What he didn't factor in this case, was that assets can just disappear into default and bankruptcy before they mature.
Yeah, I agree with that last point. I wouldn't characterize him as a great asset liability matcher, and I disagreed with that point in the book pretty strongly because ultimately it's not just a matter of duration or term. I think of asset liability matching as a function of risk management too. And so in my mind, I think he drove as fast as he could into a fog in a new asset class and didn't pause to ask the question of what happens if the drawdowns are much worse than in the brief history of this asset class. And it's not like there weren't other credit cycles to go look at to try to figure out what that could do to his portfolio. And especially in a product where, even though it's not the equivalent of a savings account where people can just withdraw money tomorrow with no penalty, there is a penalty. The penalty is pretty small. And so ultimately people can withdraw money and and trigger a run. And so I think from an asset liability matching standpoint, I sort of frame him as not particularly good, even though, like you said, the book does claim that he was great at this.
Right. And so we definitely agree that he didn't factor in that the asset side of his balance sheet can just disappear into default and bankruptcy. And that is what happens. And it happens on a grander scale than anybody could have imagined at this time period.
And there was so much concentration risk too, right? Like the concentration in Drexel is also a big red flag in any market where you have that. That's a huge failure mode.
Right. And so again, between the second half of 89 and the end of 91, 25% of the high yield market defaults. The only other time periods that have fallouts like this are the tech and telecom bubble, which we studied in a previous series, where 28% of the high yield market defaulted. And the global financial crisis actually was only 15% of the high yield market. So this is like a very serious financial crisis period. So at the start of 1990, the company is actually okay. After the $775 million write-down, First Executive still has $859 million of that equity capital that we talked about, that extra over versus what they owed. They're still the 16th biggest insurance company, and they have 13% of their assets in cash, which actually makes them the most liquid insurance carrier in America. This is all ahead of the 1990, 1991 high yield defaults, where 10% of the market is going to default in 90 and then again in 91. By October 1990, that about $1 billion of equity capital has been cut in half from defaults. And 1990 is a tough year in general. Remember, we talked earlier about how economic growth was decelerating from the Fed rate hiking cycle, and that GDP in the back half of 1990 is starting to get below 2%. Then Iraq invades Kuwait in August 1990, which kicks off the Gulf War, and that sends oil prices from $20 a barrel to $40 a barrel and tips the economy into an official recession that lasted from July of 1990 to March of 1991, and we get a bear market during that time period. The market's down almost exactly 20%. And so by the end of 1990, First Executive's equity value is down below half $500 million. We're in the middle of a recession and bear market, and people think there's more to come. And then the fire really comes with the issuance of the 1990 annual report. Says that the equity value has fallen again, really below where regulators are comfortable having a life insurance company. And their auditor has refused to issue a going concern, right? So we're actually right back to where he was at Enterprise Fund, an annual report where the auditors say this company is dead. And this is April of 1991. We still have a whole nother year of 10% defaults for this company.
Yeah, so 1991 turns out to be a very dramatic year indeed for First Executive. Now you have a company that's announced write-downs that are approaching $1 billion. You have a stock price, which we haven't really talked about the stock price too much, but at this point, the stock price has gone from about $16 in the late 80s down to 16 cents. So the market is telling you this company may not make it. And you've got policyholders who are looking for the life rafts, trying to get out. And in January 1991, a new player comes into the story. His name is John Garamendi, and he is the California Insurance Commissioner. And do you know what John Garamendi is doing today? He's still around.
What's he doing?
He is a congressman. He represents California's 8th congressional district in the House. This is kind of like northwest of San Francisco, between San Francisco and Sacramento. But he's still active. He's a prominent member of the Democratic Party in the House of Representatives. So he's still around. Garamendi is this guy from a small town in Northern California, played football and wrestled at Berkeley. He served in the Peace Corps in Ethiopia. He has a Harvard MBA, went into California state politics in the 70s. I kind of wonder if he overlapped with Michael Milken at some point during his Berkeley years. In 1990, he wins the race to become the first person ever elected as California's insurance commissioner. And when he takes office in 1991, Fred Carr's insurance company is the first crisis on his desk, the first thing he's going to tackle. And by April 1991, when First Executive announces their big loss, like you said, on that second write down, the run by policyholders on First Executive accelerates, with surrenders going from 60 policies a day to 250 plus a day. And people really are racing to get the money out, and this whole thing is collapsing. So Garamendi is pretty worried about a complete collapse of the California unit of First Executive, which is the one that he's overseeing. And so he goes to court. He gets an order placing what's called Executive Life of California, which is the First Executive California unit, placing it into conservatorship. He's basically seizing the company, and he's taking possession of its assets under the authority of the California Insurance Code. 5 days later, following the California conservatorship decision, New York does the same thing. So this insurance commissioner in New York, Salvatore Curiale, which probably has some Italian background in there, he does the same with Executive Life of New York. So now both operating units of First Executive are in state hands. And with that, Fred is gone. He resigns. He's basically gone full circle. He grew this bankrupt insurance company to the 15th largest life insurer in America, $19 billion in assets at its peak, and let it right back down to bankruptcy after 17 years.
This is a top 10 bankruptcy in the financial industry ever.
Yeah,
this is a huge bankruptcy. It's definitely it's top 5 up to this point in history.
Yeah.
So this is a very big bankruptcy.
And this is a big deal at the time. Now that the business units are in conservatorship, the goal is to stop the run. So these regulators are just trying to appease people and stabilize the situation. They try to inject some stability, calm everybody down, and they try to find a way to extract as much value as possible from the assets so they can figure out if they can make people whole. Each state has a different approach, though. So California and New York have something kind of like the FDIC, the Federal Deposit Insurance Corporation, that insures people's deposits in banks. But for insurance policies, there's nothing federal like the FDIC at the insurance level. And what happens next with the California portfolio is pretty crazy. Garamendi is going to oversee a sale that blows up in everybody's face here. So remember, he has an insurance company in California with about $10 billion in assets. The majority of this is junk bonds. And he has more than 300,000 policyholders who want to be made whole. And his job is to sell these assets or to extract as much value as possible from these investments. He runs a process. And in the end, the winner is a French group of investors called MAAF, backed by a secret subsidiary of Credit Lyonnais, which is a massive French state-owned bank. The deal closes in late 1991 and is approved by the court in December. The junk bond portfolio and the insurance business end up going for about $3.5 billion. By the way, I was very surprised when I discovered who else was involved. I think I was texting you, blowing your phone up last night, who was involved in structuring this transaction. And it turns out to be none other than Apollo. This is actually one of the early foundational deals that Apollo did when they started out in 1990, 1991. In fact, if you go to their website, this is the first deal that they talk about as foundational for the firm. Remember that Leon Black was the head of mergers and acquisitions at Drexel, and he co-founded Apollo immediately after Drexel collapsed. And so when he co-founds Apollo, one of the first things he does, naturally, coming from the junk bond world, is assemble a portfolio of distressed junk bonds. And so he participates in the purchase of Executive Life of California. What Garamendi doesn't know, though, what the court doesn't know really when they sell this, is that MAAF is a front that gave Credit Lyonnais full ownership and control of the buyer entity and the bond portfolio. And this is huge because Glass-Steagall made it illegal for a bank to own an insurance company. And more than that, California law barred foreign investment firms from controlling California insurers. And so Credit Lyonnais was in violation of both of these things. The whole arrangement here was structured to hide this, to hide the fact that they were behind this entity. But before it comes to light, Credit Lyonnais goes to work on the distressed assets with Apollo, and they end up netting out about $1 billion flipping these bonds. The California Department of Insurance eventually figures out what happened here, and they sue, and after about 16 years of litigation, they get almost $1 billion in settlements. 16 years of litigation, though. And all of this comes from Credit Lyonnais. Apollo isn't part of the lawsuit, it turns out, and ultimately, most policyholders end up with about 90 cents on the dollar, so they're kind of made whole, but not 100%. The New York unit plays out a little bit differently. New York places the business unit into what's called rehabilitation. They approved the plan in 1992. They take the high-quality surrenderable policies and sell those to MetLife, and those policyholders are made whole. And then what's left behind is the structured settlement annuities, about 10,000 people, many of them that have been catastrophically injured, and they were getting these payments from the insurance company over time. By 2010, Executive Life of New York has about $900 million in assets against $2.5 billion in liabilities. And then in 2012, after about 21 years of trying to rehabilitate this whole business unit, a New York court finally just approves liquidation. So the state has funds, kind of like the FDIC, to help plug the gap. About $800 million go into this. 90% of this is from the state fund. 10% of it comes from the industry. And roughly 1,500 of these policyholders end up seeing cuts to their benefits, some as much as 60%, which is pretty rough if you're getting 60% on the dollars on the policy that you're depending on for income. And if you're wondering what happens to the parent company, First Executive, well, they have no assets, no operations. It files for Chapter 11 in May 1991. And that's the end of the road for First Executive and Fred Carr and what happened with the primary buyer at the beginning of the junk bond market.
Right. And we thought this was the end of the story for the 80s on Wall Street, but it turns out it's not. There's another story to tell because this time period was the third largest financial crisis since 1907. The first two were the Great Depression and the Great Financial Crisis. And those were on a whole nother level. But this was the third. The California and New York state regulators are taking action in a time period when there's incredible amount of government intervention across the economy to keep things from really collapsing and spilling over into the real economy. And there's some great stories to tell there that we'll tell on the next episode.
Yes. Lest you think that this period in the 80s ends poorly, it's actually the complete opposite. This is just the beginning. This is the beginning of modern finance. And the backside of this story, which we're going to focus on the fifth episode in the series, is actually quite interesting. It's how the distressed market becomes an investable asset class in and of itself. And it's actually quite positive. And a lot of legendary investors, including a particular one that we're going to focus on, emerge from this era. So should we leave it there?
Yep.
Thank you for listening. We are really excited about our next episode. So tune in for that in a few days. In the meantime, if you enjoyed this, the best way to help us is to share this with someone you think might like it and to leave us a 5-star rating on Spotify or Apple Podcasts. See you, Matt.
See ya.